Hello and welcome back to your International Political Economy lecture series. Here we're dealing with the anatomy of balance of payments crises. We're going to talk about some of the situations countries can get into and the triggers of balance of payments crises, and we're going to use our ISLM BP model to model these. So we're going to look at a bunch of different things. I'm not going to model all of them for you. A lot of them can be modeled in very similar fashion, but we will want you to understand how to model them in the most basic fashion, certainly the ones that I present to you, and have a pretty firm understanding of how the others might trigger balance of payments crises as well. We'll move on. This is about a three-part lecture series on balance of payments crises. We're going to look at the onset of balance of payments crises in this lecture. We'll look at certain sort of contagions and spreads of balance of payments crises in future lectures, as well as possible ways of treating or dealing with balance of payments crises in later lectures as well. And this whole lecture series will set you up to give you a framework for understanding some of the country cases that we'll present to you, particularly East Asian crisis in 1997 and the Argentine crisis in 2000-2001. So as with all the material in this class, it builds on itself and it's all going somewhere. So put in the time, invest, and it will pay you dividends. The onset of a balance of payments crisis. Let's talk about a couple of the shocks, and then we'll do some modeling and talk about more of the shocks. One of the common shocks that can lead to a balance of payments crisis is a trade shock. Now, when we're dealing with trade shocks, we're talking about really a hit to your net exports. And there are a couple of ways that this can occur. Not just one way, but a couple of ways that this can occur. For instance, if one of your major export markets experienced a recession and falling income, well, this could hurt your exports relative to imports, obviously, pushing you into a trade deficit or current account deficit. Also, you could be dealing with a falling price of the good that you export. I mean, suppose that you are a Venezuela or an OPEC country and your major export is really tied to one commodity, oil. Supposing there is a dive in the global price of oil, there is a dive in the value of your exports. Now, this can happen for oil-producing countries, coffee-producing countries, soy-producing countries, but countries are vulnerable to these sort of commodity price shocks if it is the case that their export portfolio is not well diversified. Oftentimes, countries that rely on natural resources that they are endowed with, such as oil or diamonds or coffee or what have you, will fail to develop broad-based industrialization and broad-based export sectors, over-relying on one or two different types of commodities. For these countries, their export revenue and current account balance can be very vulnerable to, moving prices of that global commodity. In a similar fashion, countries that rely on certain key commodities as imports would also be vulnerable to global price shocks. If you rely heavily on importing oil and the price of oil shoots through the roof, then all of a sudden your import costs rise dramatically relative to your export revenues, and this can of course push you into a current account deficit or trade deficit. When we're modeling trade shocks, we'll be thinking about the current account and we'll be thinking about the IS curve taking a hit. We'll show you a model of this in the next slide. Large budget deficits. When we looked at our balance of payments identity, we saw that if you have a current account deficit, by definition, you must have a financial account surplus. Our second equation for this came from our leakages and injections equilibrium, and what it shows us is if you're running a trade deficit, i.e. imports over exports, then either your private or public sector must be running up debt. You either have private investment overreaching domestic savings, causing private investment to need to be funded from external savings or foreign debt, or you could have a government that was spending more than its tax revenue. This difference would have to be made up by borrowing, and this borrowing can come from foreign creditors. So you may have a savings deficit in the private sector or a revenue deficit in the government sector, or both. Now, what you'll typically see is that current account deficits are made up by foreign financing in many of the emerging market cases that we'll look at. And the interesting thing about foreign financing for emerging markets is that global investment doesn't really trust to loan to emerging markets in their own currency. This is because of histories with inflation and so on and so forth. But to a large extent, when an emerging market borrows internationally, whether that emerging market is a private sector entity or a government, a public sector entity, that it often is constrained in the sense that it cannot borrow in its own currency. Investors don't want to invest pesos into Argentina for fear that inflation will cause the value of the peso to decline and hence the value of their investment to decline. You see, for governments with large debts, they have the incentive to inflate away the cost of those debts. Borrowing in their own domestic currency would allow them to use the central bank to generate inflation such that they paid back their foreign creditors in worthless domestic currency. As a consequence of this currency risk, if you will, or inflation risk, international investors have been able to shift the risk of currency movements onto the borrower. And they do that by only allowing the borrower to borrow in some type of dominant, very prevalent, very liquid international currency. And when I say international currency, I mean a de facto international currency, not an official international currency. And that currency is typically the US dollar. So now we're beginning to see some of the manifestations of the overarching hegemony of the US dollar and of US financial institutions. For some reason, and we'll discuss this reason when we discuss the history of the dollar hegemony, the US dollar has become de facto the global currency. And many international loans and international transactions are denominated in US dollars. For instance, whenever oil is sold internationally, its value is denominated in dollars. It's quoted in dollars and paid for in dollars, even if that oil is not sold to a country that uses the US dollar as their domestic currency. So what we have here is that international investors have shifted the risk of currency movements and inflation off of themselves and onto emerging markets by only allowing emerging markets to borrow in a currency which is not their own, oftentimes the US dollar. Now, if you're thinking about this, you probably are seeing something, which is that these countries will have a mismatch, a currency mismatch. A currency mismatch is when your assets and liabilities are denominated in different currency. So a small emerging market takes out a large loan in US dollars, invests in some productive sector of their domestic economy, which is circulating, say, pesos. Their revenues and assets will be denominated in pesos, but their liabilities will be denominated in dollars. In the terminology that we will be using in this class and using frequently, I want you to think of currency mismatch as being original sin, and that's what it's referred to in the literature. So when you see something about original sin, it's not about Adam and Eve in the Garden of Eden. It is about contracting loans in foreign currency, particularly the US dollar. Now, what this does is it creates a balance sheet mismatch. Your assets and liabilities are denominated in different currency. Supposing, of course, that you suffered a depreciation of your currency, the value of your assets would fall relative to the value of your liabilities as the exchange rate depreciated. And so this can cause negative net worth shifts on the part of both the private sector or the public sector, and it can lead to debt becoming too burdensome to be paid. Of course, your assets are drying up or losing value. Your liabilities are rising simultaneously because of the movement of the exchange rate. And now you're trying to pay back your loans, and they're becoming increasingly expensive in terms of domestic currency. So I want you to be able to understand these large budget deficits and how, when they are characterized by original sin and currency mismatch, they become inherent fragilities in the balance sheet of countries or of corporations and banking systems domestically that can sort of be a ticking time bomb in the case that there is a depreciation. Expected depreciation leads expected negative balance sheets effects, possible default and or bankruptcy, and thus speculation against these companies and countries prior to the actual depreciation. So fear of these countries suffering a depreciation and turning bankrupt can lead to a vicious cycle that actually makes it occur. And so this feature of original sin, these balance sheet mismatches, will become very important as we discuss the escalation of crisis as we move forward, and all of a sudden discrete shifts from sustainable debt levels to unsustainable debt levels. So we'll come back to that in the future. No original sin, understand the currency mismatch and the possible balance sheet effects of a depreciation. Let's take a moment to rely on our understanding of the ISLM BP model, and let's take a trade shock and let's analyze it in step-by-step fashion to make sure that you are understanding how to use the ISLM model and how to apply it to some of these onset of balance of payments crises. Let's start with a simple ISLM BP model in equilibrium. I've tried to remove some of the notation to keep the clutter down. I think at this point you realize that on the vertical axis we have the domestic rate of interest, and on the horizontal axis is GDP, or Y. Our LM curve is upward sloping, IS curve downward sloping. Everything is as you would expect, and where the three musketeers' swords are crossing, we have an equilibrium. That equilibrium here occurs with open capital markets, and uncovered interest parity is holding. So the domestic rate of interest is equal to the overall foreign rate of return. That overall foreign rate of return composed of two parts: one, the foreign interest rate, and two, the expected rate of depreciation of the domestic currency. So let's talk about a negative trade shock. A negative trade shock, whatever its origin, whether it's falling export prices, rising import prices, or a collapse of an export market's demand, is going to deteriorate your net exports and shift you into a current account deficit territory. This will be modeled as the IS curve, of course, shifting leftward. As the IS curve shifts leftward, we move off of a complete three-sword equilibrium, and we're going to look at a temporary equilibrium between the LM curve and the IS. What has happened here is that economic activity has contracted, and the sort of temporary equilibrium interest rate has fallen below uncovered interest parity. It's fallen below the international rate of return. So that international rate of return hasn't changed at all yet, but the domestic rate of interest has fallen. And so we have an issue where uncovered interest parity does not hold. We've got current account deficit that's grown out of this export shock, and because the domestic rate of interest is below the international rate of return, capital will flow out of the country. At this point, we need to decide whether or not we're dealing in a fixed exchange rate regime or a flexible exchange rate regime. For this slide, we're going to be dealing with a country that has a fixed exchange rate regime. There's pressure to depreciate the currency. If a fixed If they were dealing in a fixed exchange rate regime, which we are, the central bank will defend that currency. They'll defend that currency by buying up domestic currency and selling foreign exchange. As a consequence, there will be a bleed on the foreign exchange reserves of the central bank. If the foreign exchange reserves of the central bank are plentiful enough to weather this storm, then the central bank will continue to be able to defend the exchange rate. If they are unable to have sufficient reserves to defend the exchange rate, then we'll move into a currency crisis. Now, keep in mind that as the central bank is buying up domestic currency in exchange for foreign exchange reserves and bleeding its reserves, that it is taking domestic currency out of circulation, and as a consequence, the money supply is falling. The LM curve will shift back until capital flows stop, so the LM curve will shift back, rising interest rates and contracting the money supply until the domestic interest rate is again equal to the overall foreign rate of return. What you're seeing here is that monetary policy is accommodating all flows of capital in and out of the country. Essentially, they are exacerbating the nature of the capital outflow shock. And the LM curve shifts all the way back to the edge of the IS prime curve, meaning that the size of the IS shock is fully realized in terms of volatility of real economic activity, falling output, recessions, and a rising unemployment. Let's look at a trade shock. In the other case, the case with a flexible exchange rate, again, our IS curve shifts to the left from IS to IS prime, opening up a current account deficit. So we're thinking about rising debt in this case to mirror that current account deficit. And we start to see capital outflow because uncovered interest parity no longer holds. In the case of a flexible exchange rate regime, there will be pressure to depreciate the currency, and without the central bank intervening to protect the value of that currency, the currency itself will depreciate. As the currency depreciates, it leads to two effects. The first one is that there is some improvement in your net exports. There's some improvement in your current account. That depreciation makes your exports look more attractive to rivals, and of course, foreign goods look less attractive to domestic consumers. So imports fall and exports rise to some extent. The other effect that we need to model from this depreciation is that E naught starts to climb. And as the currency depreciates, the expected future value of the currency starts to appreciate because, well, if the currency is depreciated now, it's less likely to depreciate by as much in the future. As that money moves out of the country and is expected to be repatriated back into the country into the future, the expected value of E will start to see appreciation as E naught, the spot value of E, starts to depreciate. Together, these factors will cause the expected depreciation of the currency to fall, and that will bring down the foreign rate of return, allowing us to have an equilibrium at a domestic interest rate that is lower than what it was before. Why are we able to lower the interest rate? Because we're able to lower the expected rate of depreciation as well. Foreign interest rate stays the same here. And that adjustment in the exchange rate obviously creates a buffer zone or a shock absorber to this trade shock that allows us to see a smaller decline in GDP than would have otherwise been the case in a fixed exchange rate regime. Moving on to other triggers of balance of payments crises, we have a foreign interest rate shock. Now, we've been looking at capital flows and uncovered interest parity, and of course, foreign interest rates are a key in terms of pricing that is adequate to keep capital flows inside of your country. Now, what do we mean by a foreign interest rate shock? We have to start thinking, what is the alternative investment to domestic investments? Well, regardless of what it is, that interest rate has to have secured its price at some point, and those prices are determined in markets. Now, it just so happens that the U.S. interest rate, the Treasury rate, is a benchmark interest rate for many of the other interest rates in capital markets. And this is because the United States is considered to be a risk-free borrower. The United States has never in its history defaulted on its debt obligations, and so it's considered to be about the safest investment that you can get. Zero risk is what we're looking at, right? A risk-free asset. So the way that it works is, suppose you've got two alternative investments, and one of them is risk-free and will pay you 10% on your deposit over the year, and the other one is slightly more risky, and you're asked whether or not you'd invest in the risk-free asset or the risky asset. Now, both of them are promising to give you, say, 10% over the period of a year. If you invest in the risk-free asset, you receive that 10% with absolutely no uncertainty about future payment. If, on the other hand, you invest in the riskier asset, you might get that 10%, you might get nothing, you might get some fraction of it, and you'd have to measure that risk according to the standard deviation of payments and the likelihood of being unpaid. Would you be indifferent between these two investments? Well, the answer is no. Why would you take on risk without any sort of return to compensate you for it? You just go with the risk-free investment at 10%. Well, that's great. Yeah, I think you all understand that quite well. Well, the risky asset still needs financing. So the risky borrower turns to you and says, well, you won't loan to me at 10%. Will you loan to me at 11%? You say, no, I think that compensation doesn't cover the risk I'd be facing. And so the risky borrower says, well, how about 12%, 13%, 14%, and so on and so on and so forth. At some point, right, maybe the risky borrower is offering you 20%, double what the risk-free asset was offering you. At some point, and I don't know what point that is, it would have to be determined by your risk tolerance and your pricing of risk, but at some point, you'll look at, say, the 20% rate of return, and you'll look at the risk and you'll say to yourself, I'm willing to take that chance. Now, once you've made that decision that you're willing to make that chance, and of course we don't mean you, we mean market participants in general, then the risky asset has sold. And at that point, the market has priced in the inherent risk of the risky asset at a 10% premium above the risk-free asset. So, the risky asset's rate of interest was priced based off of the risk-free asset and was priced as a premium above the risk-free asset. You here were willing to accept the risky asset at a 10% spread above the risky asset, above the risk-free asset. So now imagine that the risk-free asset increases its interest offered to 15%. Now the spread between risk-free and risky is only 5%, and that spread was too low to have you take on the risky risk. As a consequence, the interest rate that the risky asset will have to pay will increase to 25% in order to preserve that 10% spread that is required for market participants to buy into the risk premium above our risk-free asset. So what we're seeing here is that the risk-free interest rate of the United States becomes a benchmark for which all other borrowers, or many other borrowers, price their interest that needs to be paid. If the U.S. rate of interest is 3% and Argentina requires a 10% spread to borrow in international capital markets, well, then the price of Argentine debt will be 14%. If the U.S. rate of interest increases to 5%, that will automatically increase Argentina's cost of borrowing to 15%. It's as if the central banker of the United States is holding a whole bunch of balloons in his or her hand. And his hand is the risk-free interest rate, and the length of these balloon strings, which is varied, ends up becoming the risk premium attached to many other borrowing and lending throughout the financial markets. As the central banker walks up a flight of stairs, all of the costs of borrowing of all the other assets tied to the treasury rate increase, and as the central banker walks down the stairs, all of the rates of borrowing fall in a global context. So this also points to the key power and hegemony of trust and lack of default and stable inflation that the United States is able to secure over many, many decades, which is that they become the linchpin of risk pricing for the global economy. When the United States raises interest rates, it'll oftentimes do so for its own interests. The central bank will look at the American economy, assess that maybe something is wrong, perhaps we're overheating, perhaps inflation is on the rise, and may raise interest rates to achieve some domestic agenda. Now, the unfortunate consequence of this is that it increases interest rates for borrowing internationally and can oftentimes push emerging markets into a capital shortage, a negative capital flow, a negative capital shock, and a deep or mild recession. Which is why there is the old adage, when the United States sneezes, the rest of the world catches a cold. It is because of that central primacy, that central place of being the risk-free asset. So when we're talking about foreign interest rate shocks in the context of this class, oftentimes we can think of it as being the U.S. interest rate that is moving and changing the direction of capital flows internationally, changing the direction of borrowing. So when does this happen? This happens all the time. You just have to look at interest rate policy in the United States and you will see global capital flows moving. This can also happen because of changes in risk as well. So, if we are dealing with a low U.S. interest rate and some higher foreign interest rate, and all of a sudden the risk of the foreign entity increases, well, that will force them either to pay much higher interest rates, or it will cause investors to say, well, that 15% that was attached to Argentina isn't enough anymore because Argentina's risk profile has increased. Therefore, I'm moving my money out of Argentina back to a safe haven, such as U.S. assets, until interest rates climb. So these are the kind of dynamics that take place when there's a global crisis, when everything looks like it's on fire, as was the case in our most recent financial crisis in 2008, and also is the case in times of upheaval or uncertainty like the COVID pandemic of 2020. A lot of money will return to a safe haven such as the United States because uncertainty has increased and rates of borrowing haven't compensated international investors for that increase. So there's a lot in that, and we'll talk about it more in the future. So if any of that was spoken too fast or not clearly for you, we will deal with this again in our conversations and, of course, in your readings. Now, on the slide, we talk about borrowing tied to key global interest rates, and this is bullet point number 5. And it says the Treasury, which is the U.S. rate of interest, the Treasury, and the LIBOR. You may not know what the LIBOR is, and so we'll let you know what the LIBOR is. It's the other key global interest rate, and of course, it's the London Interbank Overnight Rate. You'll note that before the United States and Wall Street became the financial capital of the globe, during the first wave of globalization and the first gold standard, it was London that was the financial center of the globe, and they lost that title to the United States sometime around World War II. And so LIBOR still has a role in pricing international transactions because of its, long-standing sort of incumbency. It's grandfathered in as a useful tool. But primarily the Treasury and the LIBOR are what we think of when we think of benchmark interest rates for foreign interest rates. Let's go ahead and model this foreign interest rate shock. We start with IF increasing. The foreign interest rate has been driven up. Now, this could happen for several different reasons. We'll just say that it happens. So, IF increases, the foreign rate of interest increases, and this pushes up the overall foreign rate of return. Now, nothing's happened with the currency yet. This is IF that's rising. We model that, of course, as the BP curve equilibrium shifting up, requiring that domestic rates of interest increase in order to recover uncovered interest parity. But for the time being, uncovered interest parity does not hold. We've seen an increase in the foreign rate of return relative to domestic rates. And of course, this will cause capital outflow. As capital flows out of the economy, there will be pressure on the exchange rate to depreciate. If we're dealing with a fixed exchange rate regime, then the central bank will defend the currency by bleeding reserves and absorbing domestic money. If the central bank has adequate reserves, they will be able to defend the currency. If they don't have adequate reserves, then the currency must depreciate in a discrete and very rapid fashion, leading to profit opportunities and currency crises. But since the central bank is defending the currency, bleeding reserves, it is also absorbing these capital outflows, and it's absorbing the domestic money supply. And so the LM curve shifts back. And this shift is a shift in monetary policy that accommodates entirely the foreign interest rate shock, such that the decline in GDP and rise in unemployment will be fully felt by the economy. Now, this is our simple model of a foreign interest rate shock, the pressures on the economy that come from that, the recessionary pressures that come from that. And so you're seeing this America sneezes, the world catches a cold sort of thing, right? The U.S. raises interest rates to curb inflation, and it could force emerging markets into recession. I want to drive a hint at you about something right now, though, which is to think about how this model might change if there was the expectation that the central bank would not have adequate reserves to defend the currency. How could we play with that in this model? Now, we'll do this more extensively, I think, later on, but the hint that I have for you now is that if that were the case, it would change one aspect of our rate of return. You see, under a fixed exchange rate regime, our term expected E minus E naught over E naught, the expected depreciation of the currency, well, if the regime is credible, that's zero. There is no expected change in the currency, right? So this term, expected E minus E naught over E naught, is effectively zero if the central bank is credible, and positive if the central bank is not credible in its ability to defend the currency. Assuming that there was a widespread market speculation that the currency would fail, that term would start to increase. And that would further shift up the BP curve as confidence in the central bank's ability to defend the exchange rate was put into question. And this would put even more pressure on the domestic interest rate to rise and place even more pressure on the LM curve to shift back, exacerbating the downward movement in GDP. Now, we'll talk about this a little bit later with respect to speculation, but you're starting to see the way that market expectations can exacerbate the type of shocks that can lead a country into crises. So now we're getting into some vicious cycle sort of territory, if you will. The foreign interest rate shock, let's look at this in the case of a flexible exchange rate regime. First, we know that that foreign interest rate increased, and that caused the BP equilibrium to shift up. This left us with capital outflows. Those capital outflows put a pressure towards currency depreciation. In the case of a flexible exchange rate regime, that depreciation has two effects. On the one hand, it improves your net export position, and the IS curve shifts to the right. On the other hand, it lowers the expected rate of depreciation and causes the overall foreign rate of return to decline, and the BP curve shifts down somewhat. Whereas the foreign interest rate shock in the case of a fixed exchange rate was recessionary, here this foreign interest rate shock in the case of a flexible exchange rate regime might even have some expansionary impacts on GDP because the depreciation improves trade balances. Now, very similar, in fact, almost this exact same way as our foreign interest rate shock, we could also model political uncertainty or political risk. Now, we gave you a hint about this when we were talking about foreign interest rate shocks. There's two reasons for countries to be required to pay higher rates of return. One of them is that the rate of return needs to be a premium above the risk-free rate, and the other is that their inherent risk will drive the size of that risk premium. So just as the foreign rate of return increased with a foreign interest rate shock, well, the required rate of return for a domestic country could also increase if their risk increased, if their political uncertainty increased, for instance, or if their macroeconomic risk increased. This would mean that, individuals in capital markets were looking at the country and saying, your risk has increased for either political reasons or instability or coups or corruption or so on and so forth, and thus we're going to move capital out of the country until your rate of interest increases adequately enough to cover that additional political risk. So the way we'd model this is simply by attaching an additional risk premium to the required foreign rate of return. We would see the foreign rate of interest plus the expected rate of depreciation plus some kind of political risk, and the domestic rate of interest would have to be high enough to cover all of those sources of risk, the exchange rate risk and the inherent political risk. So we'd model it in the same way. You'd just see a shifting up of the BP curve and capital outflows until domestic interest rates rose sufficient to convince international investors to take on the amount of political risk. And those capital outflows, of course, would create pressure on the current account to move into deficit and pressure on the exchange rate as well as the central bank. But we'd model it in just the same way. So we might look at some cases where there's some political uncertainty, and this would cause capital outflows to expose current account deficits. You can imagine this being the case in numerous examples, whether it is some kind of a coup, whether it is corruption or cronyism, whether it is expected default of the banking system or expected default of the government borrower. Perhaps it is the threat that some kind of political coalition will collapse, like the case of the euro. We weren't sure if the euro was going to continue to exist after 2008 because we weren't sure whether or not Germany would be willing to help bail out the southern countries such as Greece and Italy. If they weren't willing to bail them out and act collectively as a collective country with collective interests, then of course the euro would have collapsed, damaging not only Italy and Greece, but also damaging Germany. So that type of political uncertainty could take many forms. Keep an eye out for it because it leads to moving interest rates and potentially moving currencies in the form of currency crises. An additional factor, together with political stability and foreign shocks, like the foreign interest rate shock and the foreign trade shock, would be domestic institutional quality. You'll note that some of these shocks or these triggers for balance of payments crises are external in origin, and some of them are internal in origin. It's interesting because when we look at a crisis case, the temptation is sometimes to say, what did that country do wrong and how can we fix it? Instead of thinking, well, maybe that country was doing everything right and they were the victim of a global commodity price surge or a foreign interest rate shock or excessive volatility in global capital markets. So I want you to be thorough in your analysis of country cases before you immediately blame either global capital markets or immediately blame domestic policymakers as being the source of the problem. One size does not fit all in terms of these crises policy analyses, and I want you to be sophisticated enough to know that. So what are some of the institutional quality problems that we might see as harbingers of currency crises? Well, one of them might be the domestic banking system might be weak. not very well developed. Maybe it hasn't been around for a long time. Maybe it doesn't have adequate accounting standards. Maybe it's not transparent and riddled with corruption. Maybe it misallocates credit, right? If you have a weak domestic banking system, then you're thinking that any capital inflows into the economy might be used in a way that is questionable. Might be used in a way that's excessively speculative, might be used in a way that creates financial fragilities on the balance sheets of the banking system itself. Our classic example of this will be your country case study on the East Asian countries during the crises of 1997. We'll do a full lecture on it. But essentially, the short story is there was a large credit boom, a lot of excitement in these East Asian tigers, is what they were called, because they had posted some pretty strong growth rates and they had done some institutional reform that started to make investment opportunities open to foreigners. So there's a big credit boom of people trying to take advantage of their economic growth, and the current account deficits that were present were easily covered over by capital inflows. But the way these capital inflows were structured and the way that they were used, primarily in real estate speculation, led to an increased fragility on the banking system in their balance sheets. And this, once investors became aware of it, spooked them out and caused them to evacuate capital flows. Those evacuating capital flows in turn put pressure on the currency and led to collapse of stock markets, collapse of access markets, and we'll see a widespread banking and government crisis. Another sort of piece of this institutional quality thing would be maturity mismatches, such as borrowing short-term and lending long-term. Now, this is a lot how things happen in banking, but it can lead to big problems because if you're borrowing short-term and lending long-term, you had better make sure that the payments on your long-term assets are adequate to pay off your short-term obligations coming due, or if they're not, that you have access to new short-term borrowing so that you can roll short-term liabilities off onto other short-term liabilities until your long-term assets pay out. This can, of course, become a problem if capital flows to your country dry up. You have long assets and short liabilities and no way to roll them over, exposing you to negative net worth and bankruptcy effects. So we'll talk not only about currency mismatches, which we looked at under the topic of original sin, but we'll also look at manifestations of maturity mismatches on balance sheets as well. Now, there is a general category of problems called the principal agent problem, and this is an interesting category of problems that oftentimes plays out in various crisis episodes. The idea behind the principal agent problem is that, well, you have a principal, which is someone who is administrating some kind of role. Maybe they are, say, the CEO of a company, or maybe they are your broker, or maybe they are your banker. And then you have the agent, right? Sorry, I reversed those. Let's do that again. You have the principal and the agent, right? The principal is the person who is primarily in a place to gain interest from something. They're the ones with skin in the game. They're the ones where the profit or the loss is at stake for them. And the agent is somebody that they hire to look after their best interests. So let's give you a couple examples of this. If you look at publicly held companies, many other companies as well, what you see is a CEO. That CEO runs the company, so he's the agent. But that CEO doesn't own the company, right? The company is owned by a diverse set of shareholders, maybe one majority shareholder, maybe a few very large shareholders. But the people who are running the company day to day, the CEOs and the CFOs and so on and so forth, are not the principal. They're not the person who owns the company. Now, the shareholder wants the agent to run the company such that it increases profitability and therefore increases their share price. So that's the goal of the principal. Now, what is to guarantee that the goal of the principal is symmetrically aligned with the goal of the agent? That becomes the question, right? Is it the case that the CEO inherently has the same incentive to raise profit and therefore benefit shareholders? Well, that might not be the case. The CEO might want to run the company like it's his own personal piggy bank. He might want to play empire with the company, gobbling up other companies simply to acquire territory rather than to develop productive synergies. He might use it as his own piggy bank, using corporate jets to fly hither and thither. Well, of course, that's paid for not by the CEO, but by the company, raising costs and lowering profitability. So there are a lot of ways in which the agent might think that their best interests are what they need to look after, even if it is opposed to the principal's best interests. And this leads to principal-agent problems. That agent could be your broker. That agent could be your banker. You want them to look after the stability of your portfolio and their profit, and maybe what they want to look after is short-term bonuses for their own pockets. That principal could be a bar owner, and the agent could be a bartender. Now, the bar owner wants to make money, and the bartender wants to give away free alcohol so he can get lots of tips in his pocket, right? So you're seeing many manifestations of this principal-agent problem. And these principal-agent problems can play out very profoundly in the form of banking and financial crises if there is not adequate observation and regulatory oversight of agents. When that is lacking, the principal-agent problem and the asymmetric nature of the agent's interests versus the principal's interests can lead to mismanagement and ultimate collapse. If you think about it, how does a bar owner try to make sure that the bartender isn't giving away free alcohol in order to engross his pocket with tips? Well, maybe he installs a camera and views what's happening in the bar so that there is some oversight. So regulatory oversight, supervision, and credible punishment all needs to be institutionally in play. Otherwise, principal-agent problems can lead to crises. Having things like good corporate boards or an SEC, so on and so forth, are ways in which we try to cure these principal-agent problems in various areas of economics and business. We may talk more in the future about Hyman Minsky, and his financial fragility hypothesis. It seems a bit much to give you guys at this moment. Essentially, the reading is in your readings if you'd like to peruse it. But essentially what Minsky says is that the very nature of competitive capital markets does not lead to efficient, stable markets the way we'd hope. Rather, competition in finance and banking leads individual participants to take on additional risk to push their rate of return. As each participant does this, it causes systemic risk in the system to rise as a whole, such that competition and frenzy in finance leads to increased financial fragility and inevitably crises. For Hyman Minsky, crises was not something that was an accident in capital markets. It was a consequence that was embedded in the very nature of financial markets and their participants. So for Minsky, he's very much disagreeing with, say, Adam Smith, who thinks that markets always give us supply and demand. They always give us efficient, stable outcomes. Minsky is saying, no, free and unfettered competition, at least in financial markets, will lead to recurrent financial crises. It's very interesting because Hyman Minsky's work was largely buried and forgotten about because, of course, he's positing that there's something inherently wrong with competitive markets up until the Great Recession, at which point, all of a sudden, many scholars uncovered Minsky's papers and said, wow, this looks a heck of a lot like a hypothesis that explains what we've just witnessed. A little bit about public policy and how bad public policy choices can increase the likelihood of a balance of payments crises. One of these topics is moral hazard, and you'll hear moral hazard put around a lot in econ classes, public policy classes, sociology classes, and the like. A moral hazard is when you enact some kind of regulation and it ends up encouraging exactly the type of behavior you were trying to discourage. You've put a policy in place and it creates the wrong kind of incentive. So there's this moral hazard. One of the commonly cited instances of moral hazard has to do with seatbelt laws in the United States. I believe it was in the 70s, up through about the 70s. You didn't really have to have a seatbelt in your car. You could go barreling down the freeway, and the speed limit was, I don't know, around 55 degrees or so on and so forth. The Consumer Protection Agency decided that this was a problem because so many people were dying in highway accidents. They'd be speeding, they'd crash, they'd fly through the window, they'd be dead. And so the Consumer Protection Agency forced all American manufacturers of cars and all imported cars. They said, you absolutely must have a seatbelt in your car. Otherwise, it is illegal for you to sell your product in our markets. So it was an absolute requirement for car manufacturers to put in comprehensive safety features in the form of a seatbelt into the car. This was a requirement to be sold in the United States. So, of course, this increased the cost of manufacturing for automobile manufacturers, and I'm sure that they balked and whined about it, but this was a collective federal decision designed to protect American lives, and so, of course, it got enacted. Well, thankfully, it got enacted. Now, you would think that because we had made these cars safer, that the number of highway fatalities would have declined after the Consumer Protection Agency placed seatbelts mandatory in all automobiles, right? But exactly the opposite happened. The cars were made to be safer, and then fatalities via highway deaths increased after that. So it makes you scratch your head. What was going on with this? That is completely the opposite of what we wanted. We wanted to reduce highway deaths by putting seatbelts in cars, not increase them. How do seatbelts cause death? Well, they don't cause death, right? Correlation does not necessarily mean causation, right? We put seatbelts in the car, death tolls rise. That doesn't mean seatbelts are strangling people. What happened was that once the seatbelts were in the car, people felt safer. And because they felt safer, they took on more risk in the form of driving faster and driving more recklessly. And driving faster and more recklessly does correlate to death in the way that seatbelts don't. So the causation here was that people felt safe, and then they acted more recklessly, and then we've seen an increase in highway fatalities. This is what we're talking about with moral hazard. Now, in the same fashion, we can see this moral hazard thing play out in financial markets a lot, right? Suppose that the government gives an implicit or an explicit guarantee to private companies or the private banking system that says, look, if you guys have problems with bankruptcy or so on and so forth, we'll use public money to bail you out. Right? Now, on the one hand, it creates a sense of insurance or assuredness in financial markets where people are more willing to invest because there's a backstop. Well, I'll invest in this banking system in Indonesia because if there's a problem, I'm covered probably by implicit or explicit guarantee of the Indonesian government. So it can facilitate trade because it reduces risk. Now, at the same time, does it reduce risk overall? Well, probably not. If you are an individual making a bet in Vegas and you are using your own money, you're going to be very careful about, say, how you gamble your $1,000 because you don't want to lose your $1,000. If, on the other hand, I give you $1,000 and send you to Vegas, and you say to yourself, well, heck, if I win, I keep the money, and if I lose, I didn't lose my money, I lost Matt's money or Dr. Bradbury's money. In that case, you're going to be much more willing to take on risk because the upside is all earned by you and the downside is all paid for by someone else. So the promises to bail out domestic banking and financial institutions can cause them to undertake more risk than they would otherwise, and thus make it more likely that you had speculative problems and financial crises. This is the idea of moral hazard. In these cases, the upside is private, the downside is public. So why not risk it all? We've seen this problem get large and significant in many financial markets, particularly the financial markets in the United States, with the too big to fail problems that we saw in the Great Recession. Banks like Bear and Lehman were private institutions. They were investment banks. They were inherently risky, and as such, they were outside of a lot of protections that are offered to commercial banks like FDIC insurance and so on and so forth. The idea there was if you're going to be a private bank engaging in a lot of risk, the upside's yours and the downside is yours as well. You think about America and democracy, that's typically how we like to play things out, right? If you work really hard and you win, congratulations, you're a success story, that's your money. And if you work really hard and you lose, well, that's your fault. Go do something else. So you sink or swim by your own accord, right? And we think of that as being synonymous with healthy competition in goods markets. So if you start a business and people end up loving it, well, then you make millions. And if you start a business and you can't compete and you're not good as your competitors and you're not as efficient, then the market weeds you out. You fail, right? But when a bank becomes so large and so entwined in financial markets that its bankruptcy would cause subsequent bankruptcies of other healthy firms, then all of a sudden there are negative externalities to this kind of meritocracy, where one firm does badly, makes wrong choices, excessive risk, so on and so forth, and ends up wiping out several banks that were healthy and good banks, right? So this bank has become too big, too intertwined to be allowed to fail. This creates an implicit guarantee that, hey, the government will bail them out. So what does this mean for the bank manager? What this means for the bank manager is if I just become extremely large and intertwined, then I can take on excessive amounts of risk with the likelihood that if something goes wrong, the government will pay for it. So the strategy becomes to become too large and intertwined. And once you are large and intertwined, then you can get away with tremendously risky and potentially profit opportunity where the downside is shifted onto the taxpayer. So we had this problem in 2007 and 2008, and the problem is even more enhanced today because as banks failed, we solved those failures by creating mergers such that we have even fewer large, big investment banks in the United States than prior to the crises, and an even more significant too big to fail problem. What does that mean? It means that this could be an aspect of public policy and concentration ratios in finance that are whispering in our ear about fragility towards a future crisis. There was a lot in this lecture. You may have to watch it more than once. I hope you enjoyed it. We're going to return to these themes and these lessons as we discuss the crises in Argentina and in East Asia. Your next lecture is going to be in the same vein as this, talking about the anatomy of balance of payments crises. I hope you enjoyed it. Have a lovely day wherever you are.